What if I told you that one man built a fortune so massive that it surpasses the GDP of entire countries, without inventing a new technology, without running a global empire like a tech CEO, and without trading stocks every single day? Even more surprising, what if I told you his strategy is so simple that most people ignore it? This isn't a story about luck. It's not about timing the market perfectly, and it's definitely not about chasing the next big trend. This is the story of Warren Buffett, a man who turned patience, discipline, and simple logic into one of the greatest fortunes in history. While most investors panic when markets crash, he gets excited. While others chase hype stocks, he quietly buys boring, predictable businesses. And while the world is obsessed with quick money, he focuses on building wealth slowly over decades. That's what makes his approach so powerful and so misunderstood. Because in a world full of noise, fast trades, and constant market updates, Buffett does the exact opposite. He waits, he studies, and when the opportunity is right, he acts with confidence. But here's the real question. If his strategy is so simple, why doesn't everyone follow it? Why do so many people still lose money in the market, while Buffett keeps winning, year after year? In this video, we're going to break down exactly how Warren Buffett invests, not the complicated version, not the textbook theory, but the real, practical strategy that built his fortune. And by the end of this video, you'll realize something surprising. You don't need to be a genius to invest like Buffett. You just need to think differently. Here's where most people go wrong with investing. They think it's a fast game, a game where you need to constantly buy and sell, react to news, and jump on trends before everyone else does. They open their phones, check stock prices every few minutes, and believe that success comes from being active. If a stock goes up, they rush to buy it. If it drops, they panic and sell. And if they hear about a hot stock from social media or friends, they jump in without really understanding what they're buying. This creates a cycle of emotional decisions: fear, greed, panic, excitement, and over time, these emotions destroy their returns. The biggest misconception: people believe investing is about predicting the future. They think they need to guess which company will explode next, when the market will crash, when to enter and exit perfectly. But the truth is, even professionals struggle to do this consistently. Now here's the interesting part. This entire approach is the exact opposite of how Warren Buffett invests. He doesn't try to predict short-term price movements. He doesn't chase trends. And he definitely doesn't panic when the market drops. In fact, he often ignores the market completely. Another mistake people make is treating stocks like lottery tickets. They don't think about the business behind the stock. They don't ask, how does this company make money? Is it profitable? Will it still exist in 10 or 20 years? Instead, they focus only on price. And that's dangerous, because a stock price can go up for no real reason and crash just as quickly. Without understanding the business, investing becomes pure speculation. And that's why so many people lose money. They're not investing, they're gambling. To understand how to truly build wealth in the market, you need to unlearn these habits, because the mindset that makes most people lose money is the exact opposite of the mindset that made Warren Buffett one of the richest investors in history. So how does Warren Buffett actually invest? At its core, his strategy isn't complicated. In fact, it's built on a few simple principles that almost anyone can understand, but very few people have the patience to follow. First, Buffett focuses on buying businesses, not stocks. When most people look at a stock, they see a price chart going up and down. Buffett sees something completely different. He sees a real business behind that stock, a company with products, customers, profits, and long-term potential. Before investing, he asks simple questions. Is this business easy to understand? Does it make consistent money? Does it have a strong advantage over competitors? If the answer is no, he simply walks away. Second, Buffett believes in long-term investing. He once famously said his favorite holding period is forever. That doesn't mean he never sells, but it shows how he thinks. Instead of chasing short-term gains, He focuses on companies that will grow over many years. Why does this work? Because great businesses tend to become more valuable over time. As they grow their profits, their stock price eventually follows. Short-term price movements are unpredictable, but long-term growth is much more reliable. Third, he uses something called a margin of safety. This means he doesn't just buy a great company, he buys it at the right price. Imagine a company is worth $100. Buffett won't pay $100 for it. He'll wait until he can buy it for $70 or $80. That difference gives him protection if things don't go exactly as expected. Fourth, Buffett controls his emotions. This might be the most important rule of all. When the market crashes, most investors panic and sell, but Buffett sees it as an opportunity to buy great companies at lower prices. When the market is booming and everyone is excited, he becomes more cautious. He doesn't follow the crowd. He thinks independently. And finally, Buffett relies heavily on compounding. He started investing at a young age and allowed his money to grow over decades. The longer he stayed invested, the faster his wealth grew. It's like a snowball rolling downhill. At first, it grows slowly, but over time, it becomes massive. That's the real secret behind his success. Not complexity, not luck, just simple rules, followed consistently for a very long time to truly understand how Warren Buffett invests. Let's look at a real example that perfectly reflects his strategy. One of his most famous investments is the Coca-Cola company. Back in 1988, Buffett made a bold move. He invested over $1 billion into Coca-Cola. At that time, it wasn't some fast-growing tech company or a trendy stock that everyone was talking about. In fact, many investors ignored it. Why? Because it seemed boring. But that's exactly why Buffett was interested. He saw something others didn't focus on. A product sold all over the world, brand recognized by billions of people, a business with consistent profits. Year after year, Coca-Cola had what Buffett calls a moat, a strong competitive advantage that protects a company from competitors. Think about it. No matter where you go in the world, people recognize Coca-Cola. That kind of brand power is incredibly hard to replace. Buffett understood that this wasn't just a drink, it was a long-term business with predictable growth, so instead of worrying about short-term price movements, he focused on the long-term potential, and he held the stock for decades. Today, that investment has grown into tens of billions of dollars in value. But even more importantly, Coca-Cola has paid Buffett billions in dividends over the years. That means he didn't just make money from the stock going up. He made money while holding it. Now let's look at another example. Buffett's company, Berkshire Hathaway, has also invested heavily in Apple Inc. At first glance, Apple might seem like a tech company, which Buffett traditionally avoided, but he didn't see it as just a tech stock. He saw it as a consumer brand with incredibly loyal customers and strong, consistent profits. Once again, he applied the same principles. Strong business model, predictable earnings, long-term growth potential, and, just like Coca, he held it. These examples show something important. Buffett doesn't chase trends, he finds great businesses, buys them at the right price, and holds them long enough for their true value to grow. That's how real wealth is built. So what can we learn from Warren Buffett's approach to investing? The first lesson is simplicity beats complexity. You don't need to predict the stock market, chase the latest tech hype, or spend hours analyzing every minor fluctuation in price. Buffett's success comes from focusing on businesses he understands and ignoring everything else. By simplifying your approach, you reduce mistakes and improve consistency. The second lesson is think long-term. Most investors focus on short-term gains, constantly buying and selling in reaction to market noise. Buffett, however, chooses companies he can hold for decades. This long-term perspective allows you to ride out market volatility, benefit from compounding, and avoid emotional decisions that lead to losses. Third, always consider the margin of safety. Buying a good company at the wrong price can still lead to losses. Buffett waits for the right price, one that gives him a buffer in case the company underperforms. This principle isn't just for billionaires. Anyone investing can use it by avoiding overvalued stocks and prioritizing value over popularity. Another key takeaway is emotional control. Markets are unpredictable. Prices swing up and down, sometimes violently. Most people react emotionally, buying high and selling low. Buffett does the opposite. He stays calm during crashes and is cautious during frenzies. Learning to control emotions and stick to a strategy can drastically improve investment outcomes. Next. Understand the power of compounding. Wealth doesn't happen overnight. Buffett started investing early and let his money grow over decades. Compounding is the magic that turns small, consistent investments into huge sums over time. Even if you can't invest billions like Buffett, starting early and staying consistent can produce significant results. Lastly, focus on quality businesses, not quick wins. Buffett invests in companies with strong brands, loyal customers, and predictable earnings. It's not about finding the next overnight success, it's about identifying enduring businesses that can grow steadily. This principle helps you avoid the risky get-rich-quick mentality that traps so many investors. In short, the lesson is clear. You don't need to be a genius to invest like Buffett. You need patience, discipline, and a clear understanding of what you're investing in. By applying these principles, anyone can improve their investment strategy, minimize risk, and potentially grow real wealth over time. The greatest advantage is consistency, not luck. Buffett didn't become one of the richest people in the world because he had insider information or because he took huge risks. He became rich by following these simple rules consistently, year after year. If you've watched this far, you've just uncovered the principles that made Warren Buffett one of the richest investors in history. But understanding these principles is just the first step. The real power comes when you apply them. Think about it. Most people go through life investing blindly, following the crowd, and reacting to every market fluctuation. They never stop to study how the truly successful investors think, and as a result, they never reach their financial potential. This is where the geeky investor comes in. On this channel, we break down complicated financial ideas into simple, practical strategies that anyone can understand and use, just like we did today with Warren Buffett. You'll learn how to spot quality businesses, how to think long-term, and how to harness the power of compounding for yourself. If you want to start investing smarter, rather than harder, if you want to see beyond the market noise and understand the real rules of money, then hit that subscribe button. Turn on notifications so you never miss an insight. That could change the way you think about wealth. And here's a quick challenge for you. After watching this video, take a moment to review your current investments or financial plan. Ask yourself, am I thinking long-term? Am I buying businesses I understand? Am I letting emotions drive my decisions? Am I taking advantage of compounding? If the answer is no to any of these, you've just identified where your strategy could improve. And that's where the geeky investor can guide you step by step. Remember, building real wealth isn't about luck. It's about understanding the rules, making smart choices, and staying consistent. Every video on this channel is designed to help you do exactly that, so don't wait. Subscribe now, and start learning how to make your money work for you, not the other way around. Because when you understand how money actually works, you stop just surviving financially and start building lasting wealth. One smart decision at a time. Welcome to the Geeky Investor. Your journey to financial wisdom starts here.